Question 1. Upon reviewing a draft advertisement for an investment advisory firm, the compliance officer noted several potential issues regarding the presentation of past performance. Which of the following approaches to presenting performance data in the advertisement would be considered compliant with the Series 65 regulatory framework? Option A. Presenting a hypothetical portfolio's performance that has been backtested using historical data, without disclosing the methodology or limitations of backtesting. Option B. Displaying the firm's average annual return for the past 10 years, clearly stating the benchmark used for comparison, and including a disclaimer that past performance is not indicative of future results. Option C. Advertising a specific investment strategy's performance that achieved exceptional results during a recent bull market, without disclosing the specific time period or the strategy's performance during other market conditions. Option D. Showcasing the performance of the firm's best-performing client account over the last 5 years, without mentioning the performance of other accounts or the overall firm average. The correct answer is A. Presenting a hypothetical portfolio's performance that has been backtested using historical data, without disclosing the methodology or limitations of backtesting. Explanation. This scenario is professionally challenging because performance advertising by investment advisors is heavily regulated to prevent misleading claims and protect investors. Advisors must balance the desire to showcase their success with the strict requirements of the Investment Advisors Act of 1940 and the rules promulgated by the Securities and Exchange Commission, SEC, particularly Rule 206(4)(1), the advertising rule. The core challenge lies in ensuring that any advertised performance is fair, balanced, and not likely to mislead, which requires meticulous attention to detail regarding disclosures, methodology, and the presentation of results. The correct approach involves presenting performance data that is not only accurate but also accompanied by all necessary disclosures and context. This means including information about the benchmark used, the period covered, any limitations of the performance data, and the fact that past performance is not indicative of future results. Furthermore, it requires that the performance be presented in a way that is not misleading, avoiding cherry-picking of favorable periods or omitting significant unfavorable periods. The regulatory justification stems from the anti-fraud provisions of the Investment Advisors Act and the specific requirements of the advertising rule, which mandate that advertisements must not contain any untrue statement of a material fact or omit to state a material fact necessary to make the statements made, in light of the circumstances under which they were made. Not misleading. An incorrect approach would be to advertise performance without disclosing the benchmark used. This is a regulatory failure because it deprives potential clients of crucial context to evaluate the advisor's performance relative to the market or a relevant peer group, making it impossible to assess whether the performance was due to skill or simply market movement. Another incorrect approach is to advertise only the best-performing account managed by the advisor. This is a material misrepresentation and omission, as it presents a highly selective and unrepresentative view of the advisor's overall track record, violating the principle of fair representation and potentially misleading investors into believing this level of performance is typical. Finally, advertising performance without stating that past results do not guarantee future results is a significant ethical and regulatory lapse. This omission fails to manage client expectations and can lead to unrealistic assumptions about future investment outcomes, directly contravening the spirit and letter of the regulations designed to prevent such misleading impressions. The professional decision-making process for similar situations should involve a thorough review of the proposed advertisement against the SEC's advertising rule and any relevant state regulation. Advisors should ask themselves if the advertisement presents a fair and balanced picture, if all material facts are disclosed, and if there is any potential for misinterpretation or misleading the investor. Consulting with legal counsel or compliance officers experienced in investment advisor regulation is often a prudent step before disseminating any performance advertising. Question 2. The risk matrix shows that a particular asset class exhibits a high correlation with existing holdings, a moderate expected return, and a high standard deviation. An investment advisor is considering adding this asset class to a client's portfolio, which is designed to achieve moderate growth with a defined risk tolerance. Which of the following approaches best reflects the application of modern portfolio theory, MPT, in this context? Option A. Include the asset class if its expected return, despite the high correlation and standard deviation, is sufficiently attractive to potentially enhance the overall portfolio's expected return, provided it does not push the portfolio beyond the client's risk tolerance. Option B. Include the asset class primarily because its moderate expected return aligns with the client's growth objective, with less emphasis on its correlation or standard deviation. Option C. Exclude the asset class due to its high correlation with existing holdings, as diversification is the primary goal of MPT, and this asset would not improve diversification. Option D. Exclude the asset class because its high standard deviation indicates excessive risk, regardless of its potential contribution to returns. The correct answer is A. Include the asset class if its expected return, despite the high correlation and standard deviation, is sufficiently attractive to potentially enhance the overall portfolio's expected return, provided it does not push the portfolio beyond the client's risk tolerance. Explanation: this scenario is professionally challenging because it requires an investment advisor to apply theoretical concepts of modern portfolio theory, MPT, to a client's specific circumstances, balancing risk and return in a way that aligns with the client's objectives and the advisor's fiduciary duty. The advisor must move beyond simply understanding MPT to demonstrating its practical, client-centric application within the regulatory framework governing investment advisors. The correct approach involves constructing a diversified portfolio that seeks to achieve the client's desired return for a given level of risk, or the lowest possible risk for a desired return, by selecting assets that are not perfectly correlated. This directly aligns with the principles of MPT, which posits that investors can construct portfolios to optimize their expected return based on their risk tolerance. Under the Investment Advisors Act of 1940, investment advisors have a fiduciary duty to act in the best interests of their clients. This includes providing advice that is suitable and tailored to the client's financial situation, investment objectives, and risk tolerance, which is precisely what an MPT-driven approach aims to achieve. An incorrect approach that focuses solely on maximizing returns without considering the associated risk or the client's tolerance for that risk fails to uphold the fiduciary duty. It prioritizes a single metric over a holistic assessment of the client's needs and can lead to unsuitable recommendations. Another incorrect approach that emphasizes only minimizing risk without regard for achieving any meaningful return would also be a failure, as it neglects the client's potential need for growth and income, thereby not acting in their best interest to achieve their financial goals. Finally, an approach that selects assets based purely on historical performance, without considering their correlation or contribution to overall portfolio diversification, ignores a core tenet of MPT and can lead to a portfolio that is not optimally constructed for risk-adjusted returns, potentially exposing the client to unnecessary or uncompensated risk. Professional decision-making in such situations requires a systematic process. First, thoroughly understanding the client's financial situation, investment objectives, and risk tolerance. Second, applying relevant investment theories, such as MPT, to identify potential portfolio structures that align with these client parameters. Third, selecting specific investments that fit within the chosen portfolio structure and meet the client's needs. Finally, continuously monitoring and rebalancing the portfolio to ensure it remains aligned with the client's evolving circumstances and market conditions, all while adhering to the advisor's fiduciary obligations and regulatory requirements. Question 3. Process analysis reveals that an investment advisor representative has learned of material non-public information regarding a company whose securities are publicly traded. The representative is considering how to respond to this information, understanding that the regulatory framework for insider trading is stringent. Which of the following best describes the potential penalties under U.S. federal securities laws for engaging in insider trading? Option A. Civil fines up to 3 times the profit gained or loss avoided, disgorgement of profits, prejudgment interest, and potential criminal sanctions including imprisonment and substantial fines for individuals and firms, alongside industry bars. Option B. A minor administrative fine and a temporary suspension from certain non-advisory activities. Option C. Only civil penalties limited to the amount of profit gained or loss avoided, with no possibility of criminal prosecution. Option D. A warning from the Securities and Exchange Commission, SEC, and a requirement to attend a compliance seminar. correct answer is A. Civil fines up to 3 times the profit gained or loss avoided, disgorgement of profits, prejudgment interest, and potential criminal sanctions including imprisonment and substantial fines for individuals and firms, alongside industry bars. Explanation. This scenario presents a professional challenge because it requires an investment advisor representative to navigate the complex and severe penalties associated with insider trading, as defined by U.S. federal securities laws, particularly the Securities Exchange Act of 1934 and its related rules. The advisor must understand not only the direct legal consequences for individuals and firms, but also the broader reputational and business implications. The challenge lies in accurately identifying the scope of these penalties and distinguishing them from less severe regulatory actions. The correct approach involves recognizing that penalties for insider trading are multifaceted and can include significant civil and criminal sanctions. Civil penalties, often imposed by the Securities and Exchange Commission, SEC, can include disgorgement of profits, prejudgment interest, and civil fines up to 3 times the profit gained or loss avoided. Criminal penalties, pursued by the Department of Justice, can result in substantial prison sentences and criminal fines for individuals, as well as significant fines for the employing firm. Furthermore, individuals found liable for insider trading may face industry bars, preventing them from working in the securities industry. This comprehensive understanding aligns with the strict enforcement and deterrent goals of U.S. securities regulation. An incorrect approach would be to underestimate the severity of penalties, focusing only on minor sanctions, or assuming that only individuals directly engaging in the trading are liable. For instance, suggesting that penalties are limited to a simple warning or a small administrative fine fails to acknowledge the robust enforcement mechanisms designed to deter such misconduct. Another incorrect approach would be to conflate insider trading penalties with those for other, less serious violations, such as minor record-keeping errors. This demonstrates a lack of understanding of the specific statutes and rules governing insider trading and the gravity with which it is treated by regulators. A further incorrect approach might be to assume that a firm is shielded from penalties if its employees engage in insider trading, ignoring the firm's potential liability for failure to supervise or for creating an environment where such activity could occur. Professionals should employ a decision-making framework that prioritizes a thorough understanding of applicable laws and regulations. This involves continuous education on enforcement actions and penalty structures, consulting with legal counsel when in doubt, and implementing robust compliance programs designed to prevent and detect insider trading. When faced with a situation involving potential insider trading, the professional's duty is to act with utmost diligence, report suspicious activity through appropriate channels, and avoid any action that could be construed as facilitating or concealing such illegal conduct. Question 4. Examination of the data shows that a financial planner who is compensated for providing personalized investment advice regarding securities to clients is associated with a firm that is registered as an investment advisor IA at the federal level. The planner operates in multiple states. Which of the following best describes the planner's registration obligations as an investment advisor representative IA? Option A. The planner only needs to register as an IA at the federal level, as their role is to represent the federally registered firm. Option B. The planner must register as an IAR in each state where they provide investment advice for compensation, as they are associated with a federal covered IA and meet the definition of an IAR. Option C. The planner is exempt from IAR registration as long as the investment advice is incidental to their broader financial planning services. Option D. The planner is exempt from IAR registration in all states because their employing firm is federally registered as an IA. The correct answer is B. The planner must register as an IAR in each state where they provide investment advice for compensation, as they are associated with a federal covered IA and meet the definition of an IAR. Explanation. This scenario presents a professional challenge because it requires an investment advisor representative IR to navigate the nuances of registration requirements under the Investment Advisors Act of 1940 and state securities laws, specifically concerning the definition of investment advisor and the exemptions available. The IAR must accurately determine if their activities necessitate registration as an IAR in a particular state, which hinges on whether they are providing investment advice for compensation, and are associated with an investment advisor. Misinterpreting these requirements can lead to significant regulatory penalties, including fines, sanctions, and reputational damage. Careful judgment is required to distinguish between activities that trigger registration and those that do not, ensuring compliance with the complex web of federal and state regulations. The correct approach involves a thorough understanding of the definition of an investment advisor and the criteria for IAR registration. Specifically, it requires assessing whether the individual is receiving compensation for providing advice about securities or for the issuance of reports or analyses concerning securities, and if they are employed by or associated with an investment advisor. If these conditions are met and no applicable exemption applies, then registration as an IAR in the relevant state is mandatory. This approach is correct because it directly aligns with the core provisions of the Investment Advisors Act of 1940 and the Uniform Securities Act, which govern IAR registration. Adhering to this framework ensures compliance with federal and state laws, protecting both the individual and their clients from regulatory violations. An incorrect approach would be to assume that simply not being a registered investment advisor, RIA, absolves one of IAR registration obligations. This is a regulatory failure because the definition of an investment advisor is broad and can encompass individuals acting on behalf of an RIA. If an individual is compensated for providing investment advice and is associated with an RIA, they are generally considered an IAR and must register, even if the RIA itself is registered. Another incorrect approach is to believe that if the advice is incidental to another profession, such as accounting or law, registration is automatically unnecessary. While certain exemptions may exist for incidental advice, they are narrowly construed and typically require that the advice not be special or separate compensation, and that it be incidental to the practice of another profession. Failing to analyze the specific nature of the compensation and the advice provided, and relying on a blanket assumption of exemption, is a regulatory failure. A third incorrect approach is to focus solely on the federal registration of the employing firm, without considering state-level IAR registration requirements. The Series 65 exam emphasizes that IARs must register in every state where they conduct business, regardless of their firm's federal registration status. Overlooking state-specific registration mandates is a critical regulatory oversight. The professional reasoning process for similar situations should involve a systematic analysis of the individual's activities against the definitions and requirements of the Investment Advisors Act of 1940 and the relevant state securities laws. This includes 1. Identifying if the individual is providing advice about securities, issuing reports or analyses concerning securities, or managing securities for others. 2. Determining if they are receiving compensation for these activities. 3. Ascertaining if they are employed by or associated with an investment advisor. And 4. Researching any applicable exemptions. If the core conditions for registration are met, the professional must then proceed with the necessary registration filings in all relevant jurisdictions. Consulting with legal counsel or compliance professionals is advisable when in doubt. Question 5. Assessment of the initial registration process for a newly formed investment advisory firm. What is the most critical step in ensuring compliance with Part 1 of Form ADV regarding the firm's business and ownership structure? Option A. Disclosing only the majority owners and excluding any individuals with minority stakes, regardless of their influence on management. Option B. Omitting disclosure of any past regulatory actions against principals if the actions were settled without an admission of guilt. Option C. Providing a general overview of the firm's intended business activities without detailing specific services or ancillary offerings. Option D. Accurately identifying and disclosing all individuals with control over the firm, including significant minority owners and their respective ownership percentages, and detailing all business activities and services offered. The correct answer is D. Accurately identifying and disclosing all individuals with control over the firm, including significant minority owners and their respective ownership percentages, and detailing all business activities and services offered. Explanation. Scenario analysis. This scenario presents a common implementation challenge for investment advisors when establishing their business. The challenge lies in accurately and completely disclosing all material information about the firm's business operations and ownership structure to prospective clients and regulators, as required by the Investment Advisors Act of 1940 and state securities laws. Failure to do so can lead to regulatory sanctions, reputational damage, and loss of client trust. The advisor must navigate the specific disclosure requirements outlined in Form ADV, ensuring all relevant sections are completed accurately and without omission. Correct approach analysis. The correct approach involves a thorough review and completion of all relevant sections of Form ADV Part 1. This includes accurately identifying all individuals with control, detailing the firm's business activities, and disclosing any disciplinary events. This approach is mandated by the Securities and Exchange Commission, SEC, and state securities administrators. Form ADV Part 1 serves as the primary disclosure document for investment advisors, providing essential information about their business, ownership, and personnel to the public and regulators. Adhering strictly to these requirements ensures compliance with federal and state registration and disclosure obligations. Incorrect approaches analysis. An approach that omits disclosing a significant minority owner who has the authority to influence the firm's management decisions is a failure to accurately represent the firm's ownership structure. This violates the requirement for full and fair disclosure under the Investment Advisors Act of 1940, as such ownership can be material to a client's decision to engage the advisor. An approach that fails to disclose a past regulatory action against a key principal, even if it was settled without an admission of guilt, is also a violation. Form ADV Part 1 requires disclosure of such events, as they can be material information for prospective clients and regulators to assess the advisor's integrity and business practices. An approach that only discloses the firm's primary business activity and neglects to mention ancillary services offered, such as financial planning or tax preparation, is incomplete. Form ADV requires a comprehensive description of all services offered to clients, as these services can impact the advisor's fiduciary duties and potential conflicts of interest. Professional reasoning. Investment advisors must prioritize accuracy and completeness in their regulatory filings, particularly Form ADV Part 1. The decision-making process should involve a meticulous review of all disclosure requirements, consultation with legal counsel or compliance experts if necessary, and a commitment to transparency. When in doubt about the materiality of information, it is always prudent to err on the side of disclosure. The core principle is to provide prospective clients and regulators with a clear and comprehensive understanding of the advisor's business and any potential risks. Question 6. Which approach would be most appropriate for an investment advisor who has recently expanded their client base to include individuals in 3 different states while managing a total of $120 million in assets under management and has not previously registered with the SEC? Option A. Continue operating under state registration in the original state, as the client base is still relatively small. Option B. Register with the Securities and Exchange Commission, SEC. Option C. Seek an exemption from registration based on the limited number of states involved. Option D. Register with the securities regulators of each of the 3 states where clients reside. The correct answer is B. Register with the Securities and Exchange Commission, SEC. Explanation. This scenario presents a common challenge for investment advisors, determining the appropriate registration framework when operating across state lines and managing assets for clients in multiple jurisdictions. The core difficulty lies in navigating the dual regulatory system of federal SEC and state NASA registration, understanding the thresholds and exemptions that dictate which authority has oversight. Professional judgment is crucial to ensure compliance and avoid significant penalties. The correct approach involves a thorough analysis of the advisor's business model, client base, and assets under management to determine if federal registration with the SEC is required or if state registration is sufficient. Under the Investment Advisors Act of 1940, advisors with $100 million or more in AUM are generally required to register with the SEC. Advisors managing less than $100 million typically register with the state in which they operate and have clients. Furthermore, certain exemptions exist, such as for intrastate advisors or those solely advising registered investment companies. Accurately assessing AUM and client locations is paramount. An incorrect approach would be to assume that because the advisor has clients in only one state, state registration is always sufficient, regardless of AUM. This fails to recognize the federal threshold for SEC registration. If the advisor manages $100 million or more in AUM, they are subject to federal registration and oversight by the SEC, even if all their clients reside in a single state. Failure to register federally when required is a direct violation of the Investment Advisors Act of 1940. Another incorrect approach would be to register with the SEC solely because the advisor has clients in multiple states, without first confirming that their AUM meets the federal threshold. While having clients in multiple states often points towards federal registration, it is not the sole determinant. If the AUM is below $100 million and no other federal registration triggers apply, e.g., advising an investment company, then state registration in each relevant state would be the appropriate path. Registering federally unnecessarily can lead to increased compliance burdens and costs without a regulatory mandate. A final incorrect approach would be to ignore registration requirements altogether, believing that a small client base or limited operational footprint exempts the advisor. This is a critical ethical and regulatory failure. The Investment Advisors Act of 1940 and state securities laws are designed to protect investors, and registration is a fundamental mechanism for achieving this. Operating as an unregistered investment advisor when registration is required carries severe penalties, including fines, disgorgement of fees, and prohibitions from the industry. The professional decision-making process should begin with a clear understanding of the advisor's business operations, including the total value of assets managed and the geographic location of all clients. This information should then be cross-referenced with the AUM thresholds for SEC registration and the criteria for state registration and any applicable exemptions. Consulting with legal counsel specializing in securities law is often advisable to ensure accurate interpretation and compliance with the complex federal and state regulatory landscape. Question 7. Implementation of a new investment strategy for a client, which involves complex derivatives, requires the investment advisor to communicate the strategy's potential benefits and risks. Which of the following approaches best adheres to the regulatory framework governing investment advisors under U.S. federal law? Option A. Presenting a detailed analysis of the strategy's potential for high returns, supported by historical performance data of similar strategies, while also clearly outlining the specific risks associated with derivatives, including the potential for significant loss and leverage. Option B. Emphasizing the innovative nature of the strategy and its potential to outperform traditional investments, without delving into the technical complexities or specific risk factors of the derivatives involved. Option C. Providing a general overview of the strategy's objectives and highlighting only the most favorable potential outcomes, while downplaying or omitting discussion of the specific risks and potential for loss. Option D. Focusing on the theoretical advantages of the derivatives used, assuming the client possesses a sophisticated understanding of complex financial instruments and therefore requires minimal explicit risk disclosure. The correct answer is A. Presenting a detailed analysis of the strategy's potential for high returns, supported by historical performance data of similar strategies, while also clearly outlining the specific risks associated with derivatives, including the potential for significant loss and leverage. Explanation. This scenario presents a common challenge for investment advisors, balancing the need to provide comprehensive advice with the regulatory requirement to avoid making misleading statements or omissions. The challenge lies in accurately communicating the risks and benefits of an investment strategy without overpromising or understating potential downsides, all while adhering to the stringent disclosure requirements of the Investment Advisors Act of 1940 and the rules promulgated by the SEC. The correct approach involves a thorough and transparent disclosure of all material information. This includes clearly outlining the investment strategy, its associated risks, potential benefits, and any limitations. It requires the advisor to act in the client's best interest, a fiduciary duty, by ensuring the client fully understands what they are investing in. This approach aligns with the anti-fraud provisions of the Investment Advisors Act, which prohibit deceptive or manipulative practices. Specifically, Rule 206.4-1, the advertising rule, and Rule 206.4, -8. The custodial rule, when applicable to pooled investment vehicles, are relevant, emphasizing the need for fair dealing and accurate representation. The advisor must ensure that any performance data presented is not misleading and that all relevant risks are adequately disclosed. An incorrect approach that focuses solely on highlighting potential gains without adequately disclosing risks is a direct violation of the Investment Advisors Act. This constitutes a misrepresentation and omission of material facts, which is inherently misleading and breaches the fiduciary duty owed to the client. Such an approach could lead to clients making investment decisions based on incomplete or inaccurate information, potentially resulting in significant financial harm. This directly contravenes the spirit and letter of federal securities laws designed to protect investors. Another incorrect approach that omits discussion of specific fees or expenses associated with the strategy is also problematic. While the question focuses on the strategy itself, comprehensive disclosure under the Investment Advisors Act extends to all material aspects of the advisory relationship, including compensation. Failing to disclose fees can lead to a client being unaware of the true cost of the advice, impacting their net returns and potentially leading to dissatisfaction or disputes. This omission can be viewed as a failure to deal fairly and honestly with the client. Finally, an approach that relies on vague or generalized statements about the strategy's success without providing specific, verifiable information or context is also insufficient. The SEC emphasizes the importance of specificity and accuracy in investment advisor communications. Generalized claims can be interpreted as puffery, but when presented as part of an investment recommendation, they can be misleading if not substantiated, or if they fail to acknowledge the inherent uncertainties of investing. The professional decision-making process for similar situations should begin with a thorough understanding of the client's objectives, risk tolerance, and financial situation. This understanding then informs the selection and presentation of investment strategies. Crucially, all communications must be reviewed against the backdrop of the Investment Advisors Act of 1940 and relevant SEC rules, particularly those concerning advertising, disclosure, and fiduciary duty. Advisors should err on the side of over-disclosure rather than under-disclosure, ensuring that clients receive a complete and balanced picture of any investment recommendation. Consulting with compliance personnel or legal counsel is advisable when in doubt about the adequacy of disclosures. Question 8. The evaluation methodology shows that an investment advisor representative is approached by a client who expresses a strong desire to invest in a highly speculative, emerging market cryptocurrency that has experienced extreme volatility. The client states they have done their own research and are confident in its potential for rapid gains, and they want the advisor to facilitate this investment through their advisory account. The advisor's firm does not typically recommend such assets, and the advisor has concerns about the asset's regulatory status and inherent risks. Which of the following represents the most appropriate course of action for the investment advisor representative, strictly adhering to the definition and permissible uses of investment advisory services under U.S. federal securities laws? Option A. Immediately execute the client's requested trade, as the client has explicitly directed the transaction, and the advisor's role is to follow client instructions. Option B. Provide the client with general information about the cryptocurrency market and its risks, but decline to discuss or facilitate any specific investment in the cryptocurrency, citing the firm's policy against speculative assets. Option C. Conduct a thorough suitability analysis of the cryptocurrency and its associated risks in relation to the client's overall financial situation, investment objectives, and risk tolerance. If deemed suitable, proceed with facilitating the investment while clearly documenting the rationale and risks. If deemed unsuitable, explain the reasons to the client and propose alternative suitable investment strategies. Option D. Inform the client that the firm does not handle such investments and suggest they open a separate brokerage account with a firm that specializes in alternative assets to pursue their desired strategy. The correct answer is C. Conduct a thorough suitability analysis of the cryptocurrency and its associated risks in relation to the client's overall financial situation, investment objectives, and risk tolerance. If deemed suitable, proceed with facilitating the investment while clearly documenting the rationale and risks. If deemed unsuitable, explain the reasons to the client and propose alternative suitable investment strategies. Explanation. This scenario presents a professional challenge because it requires an investment advisor representative to balance the client's immediate financial needs with the long-term implications of their investment strategy, all while adhering to strict regulatory definitions and permissible uses of advisory services. The core of the dilemma lies in determining whether the client's request for a specific, potentially unsuitable, investment strategy falls within the scope of permissible advisory services, or if it crosses into providing unlicensed services or engaging in prohibited conduct. The correct approach involves the investment advisor representative carefully evaluating the client's request against the definition of investment advice and the permissible uses of their advisory services as defined by the Investment Advisors Act of 1940 and related SEC interpretations. This means understanding that providing general information or analysis is permissible, but recommending specific securities or strategies without proper due diligence and suitability assessment, especially when the client's stated goal is speculative, could be construed as providing advice that is not in the client's best interest or engaging in activities that require a different license. The advisor must act as a fiduciary, prioritizing the client's interests, which necessitates a thorough suitability analysis and a clear explanation of risks, even if it means declining to implement a strategy the client desires. An incorrect approach would be to immediately implement the client's requested strategy without a comprehensive suitability assessment. This fails to uphold the fiduciary duty, as it prioritizes the client's stated desire over their actual best interests, potentially exposing them to undue risk. It also risks violating regulations that require advisors to have a reasonable basis for believing their recommendations are suitable for the client. Another incorrect approach would be to refuse to discuss any investment strategies with the client, citing a broad interpretation of permissible uses that stifles legitimate client engagement. While advisors must operate within their defined scope, completely shutting down discussion about potential strategies, even to explain why a particular one might be unsuitable, can be seen as a failure to provide adequate service and guidance, potentially leading the client to seek advice elsewhere from less scrupulous sources. A third incorrect approach would be to offer to facilitate the client's desired strategy by suggesting they open an account with a broker-dealer that specializes in such investments, without clearly delineating the advisor's role and the limitations of their own services. This could create a perception of endorsement or involvement in a strategy that the advisor has not fully vetted or is not licensed to advise on directly, potentially leading to confusion about responsibilities and liabilities. The professional decision-making process for similar situations should begin with a clear understanding of the client's objectives and risk tolerance. This should be followed by an objective assessment of the proposed strategy against the advisor's regulatory obligations, including fiduciary duty and suitability requirements. If the proposed strategy appears unsuitable or outside the scope of permissible advisory services, the advisor must clearly communicate their concerns and the regulatory basis for their position to the client. The advisor should then offer alternative, suitable strategies that align with the client's goals and risk profile, always prioritizing the client's best interests. Question 9. During the evaluation of an investment advisor representative's interstate business activities, it is determined that the representative, who is properly registered in their home state, has begun providing investment advice and managing portfolios for clients residing in a neighboring state. The representative's firm is registered in both states. The representative occasionally travels to the neighboring state to meet with these clients. Which of the following actions best ensures compliance with state registration requirements? Option A. The representative should immediately register as an investment advisor representative in the neighboring state, as providing investment advice and managing portfolios for clients residing there, coupled with travel to meet them, generally triggers registration requirements. Option B. The representative can continue to provide advice and manage portfolios without registering in the neighboring state, as their firm is already registered there, and the advice is provided to existing clients. Option C. The representative should rely on the de minimis exemption, assuming that the limited number of clients and occasional travel do not necessitate registration in the neighboring state. Option D. The representative should wait for a formal inquiry from the neighboring state's securities regulator before taking any action regarding registration. The correct answer is A. The representative should immediately register as an investment advisor representative in the neighboring state, as providing investment advice and managing portfolios for clients residing there, coupled with travel to meet them, generally triggers registration requirements. Explanation: this scenario presents a common challenge for investment advisor representatives IR transitioning between states, understanding and complying with varying state registration requirements. The professional challenge lies in accurately identifying when an IAR's activities necessitate registration in a new state, as failure to do so can lead to significant regulatory penalties, including fines, disciplinary actions, and reputational damage. Careful judgment is required to distinguish between de minimis activities that may not trigger registration and those that do. The correct approach involves proactively researching and adhering to the specific registration requirements of each state where an investment advisor representative solicits business or provides investment advice. This means understanding that even limited contact or advice rendered from a state where the IAR is not registered can trigger registration obligations. The Series 65 exam emphasizes that registration is required if an individual is an investment advisor representative, as defined by state law, which typically includes individuals who provide investment advice or manage investment portfolios for compensation, and are employed by or associated with an investment advisor. The North American Securities Administrators Association, NASA, Model Rule 202, D-1, which many states adopt, provides guidance on when an investment advisor representative must register in a state, generally requiring registration if the individual has an office in the state, regularly solicits business in the state, or provides advice to clients in the state. An incorrect approach would be to assume that because an IAR is registered in their home state and their firm is registered in the new state, they are automatically permitted to solicit clients in the new state without individual registration. This ignores the fact that state securities laws often require individual IAR registration, not just firm registration, to protect investors within that state. Another incorrect approach is to rely solely on the de minimis exemption without a thorough understanding of its specific limitations and applicability in the target state. Many states have specific thresholds for de minimis exemptions, and these can vary. Assuming a de minimis exemption applies without verifying the state's specific rules is a significant regulatory failure. Finally, delaying registration until a client complaint or regulatory inquiry arises is a reactive and unacceptable approach that demonstrates a lack of due diligence and a disregard for compliance. Professional decision-making in such situations requires a proactive and diligent approach. Professionals should always consult the securities laws and regulations of the relevant states before engaging in any advisory activities. This includes reviewing the state's definition of an investment advisor representative, registration thresholds, and any applicable exemptions. Utilizing resources like the state securities regulator's website, NASA guidance, and consulting with legal or compliance professionals are crucial steps in ensuring compliance. Question 10. Process analysis reveals that a growing investment advisory firm, initially compliant with Series 65 requirements regarding its written code of ethics, is facing challenges in ensuring consistent adherence and understanding among its expanding team. The firm has distributed the code to all employees and has a policy for disciplinary action for violations. However, there is a perceived lack of proactive engagement with the ethical principles outlined in the code. Which of the following approaches best addresses the firm's implementation challenge while adhering to regulatory expectations for a written code of ethics? Option A. Focus solely on increasing the severity of penalties for code violations to deter future misconduct. Option B. Rely on the initial distribution of the Code of Ethics document and reinforce the existing disciplinary policy for any identified violations. Option C. Implement a comprehensive, ongoing training program tailored to different employee roles. Establish clear channels for reporting potential ethical breaches without fear of reprisal, and ensure senior management actively champions the code's principles. Option D. Assign the sole responsibility for Code of Ethics oversight and enforcement to a newly hired compliance assistant with minimal direct supervision. Correct answer is C. Implement a comprehensive ongoing training program tailored to different employee roles. Establish clear channels for reporting potential ethical breaches without fear of reprisal, and ensure senior management actively champions the code's principles. Explanation: This scenario presents a common implementation challenge for investment advisors, balancing the need for a robust code of ethics with the practical realities of a growing firm. The challenge lies in ensuring that the code is not merely a document on paper, but is actively understood, followed, and enforced by all personnel, especially as the firm scales. Careful judgment is required to adapt the code's implementation without compromising its integrity or regulatory compliance. The correct approach involves a multifaceted strategy that includes regular, tailored training for different roles within the firm, clear communication channels for reporting potential violations, and a commitment from senior management to lead by example. This approach is correct because it directly addresses the requirements of the Series 65 exam's focus on ethical conduct and fiduciary duty. Specifically, SEC Rule 204A1 under the Investment Advisors Act of 1940 mandates that investment advisors adopt and implement a written code of ethics. This rule requires that the code address certain subject matters, including insider trading, personal securities transactions, and the reporting of certain securities holdings and transactions by supervised persons. Furthermore, the code must require that supervised persons be provided with a copy of the code and any amendments, and that they acknowledge receipt. The correct approach ensures these requirements are met through ongoing education and clear reporting mechanisms, fostering a culture of compliance. An incorrect approach that relies solely on a one-time distribution of the code document fails because it neglects the crucial element of comprehension and ongoing reinforcement. While it might satisfy the technical requirement of providing the code, it does not ensure that supervised persons understand their obligations or the firm's expectations regarding ethical conduct. This can lead to unintentional violations and a lack of accountability. Another incorrect approach that focuses only on disciplinary actions for violations, without proactive education and clear reporting procedures, is also flawed. This reactive stance can create an environment of fear rather than ethical awareness. It fails to foster a culture where employees feel comfortable raising concerns or seeking guidance, which is essential for preventing violations before they occur. Furthermore, it may not adequately address the proactive measures required by the rule, such as ensuring employees are aware of the firm's policies on personal trading and conflicts of interest. A third incorrect approach that delegates the entire responsibility for code of ethics compliance to a single, junior employee without adequate oversight or resources, also problematic. This approach risks insufficient implementation and enforcement. The complexity of regulatory requirements and the importance of ethical conduct necessitate a commitment from senior management and a structured approach to compliance that cannot be effectively managed by a single individual without proper authority and support. The professional decision-making process for similar situations should involve a thorough understanding of the regulatory requirements, an assessment of the firm's current operational capacity, and a proactive strategy for embedding ethical principles into the firm's culture. This includes regular review and updating of the code, comprehensive and role-specific training, establishing clear and accessible reporting mechanisms for ethical concerns, and demonstrating a consistent commitment to ethical conduct from the top down. Question 11. Performance analysis shows that a client's portfolio has experienced significant gains over the past year. An investment advisor is preparing to present a new advisory contract to this client, which includes a performance-based fee structure. The advisor intends to highlight the potential for increased compensation during periods of strong performance, but is considering omitting detailed explanations of the specific benchmark, calculation methodology, and the potential for higher fees compared to a fixed fee, believing the client will understand the general concept, which approach best adheres to the regulatory framework governing investment advisors. Option A. Fully disclose the performance-based fee structure, including the benchmark, calculation methodology, and the potential for higher fees compared to a fixed fee, ensuring the client understands the implications before signing the contract. Option B. Present the performance-based fee structure, emphasizing the potential for increased compensation during strong market performance, but provide only a general overview of how the fee is calculated. Option C. Highlight the benefits of a performance-based fee structure and downplay the possibility of significantly higher fees during periods of strong market performance. Option D. State that the fee is performance-based and assume the client understands the implications based on their investment experience. The correct answer is A. Fully disclose the performance-based fee structure, including the benchmark, calculation methodology, and the potential for higher fees compared to a fixed fee, ensuring the client understands the implications before signing the contract. Explanation. This scenario presents a professional challenge because an investment advisor must balance providing comprehensive and transparent information to a client with the practicalities of contract negotiation and ongoing service delivery. The advisor has a fiduciary duty to act in the client's best interest, which necessitates clear disclosure of all material facts, especially those impacting fees and services. Failing to adequately explain the implications of a performance-based fee structure, particularly regarding the calculation methodology and potential for increased costs, violates the principles of fair dealing and client protection mandated by the Investment Advisors Act of 1940 and its associated rules. The correct approach involves a thorough and explicit explanation of the performance-based fee structure. This includes detailing the benchmark used, the measurement period, the hurdle rate, if any, and how gains and losses are factored into the fee calculation. It also requires clearly articulating that this fee structure can lead to higher advisory fees during periods of strong market performance compared to a fixed fee. This aligns with the regulatory requirement for investment advisors to provide clients with a written advisory contract that clearly outlines the terms of the engagement, including the basis of the fee, and to disclose any potential conflicts of interest. The advisor's fiduciary duty compels them to ensure the client fully understands the financial implications of the proposed fee arrangement before signing the contract. An incorrect approach would be to simply state that the fee is performance-based, without elaborating on the specifics of its calculation and potential impact on the client's overall costs. This failure to provide sufficient detail constitutes a lack of transparency and can mislead the client into believing the fee structure is more advantageous or less costly than it might actually be. Such an omission violates the duty of care and the prohibition against fraudulent, deceptive, or manipulative practices under the Advisors Act. Another incorrect approach is to assume the client understands the nuances of performance-based fees based on their general investment knowledge. Advisors cannot rely on assumptions. They must actively ensure client comprehension of all material terms. This oversight can lead to disputes and regulatory scrutiny. Finally, an incorrect approach is to downplay the potential for higher fees during strong market periods. While the goal is to secure a contract, misrepresenting or minimizing potential costs is unethical and a violation of disclosure requirements. The professional decision-making process in such situations should prioritize client understanding and informed consent. An advisor should always err on the side of over-disclosure when it comes to fees and contract terms. This involves proactively explaining complex fee structures, providing written documentation that clearly outlines all aspects of the fee, and allowing ample time for the client to ask questions and seek clarification. The advisor should also consider whether a performance-based fee is truly in the client's best interest, given their risk tolerance and investment objectives, and be prepared to offer alternative fee structures if appropriate. Question 12. Cost-benefit analysis shows that, while concentrating investments in a few high-conviction, high-growth stocks might offer the potential for outsized short-term gains, it also significantly increases unsystematic risk. A client, however, expresses a strong preference for this concentrated approach, citing a desire for simplicity and maximum immediate returns, and is resistant to broader diversification. As a Series 65 licensed investment advisor, what is the most appropriate course of action? Option A. Suggest that the client seek advice from a different professional who is more aligned with their investment philosophy, as the advisor cannot ethically recommend such a concentrated strategy. Option B. Explain the principles of diversification and its role in mitigating risk, guiding the client towards a more balanced portfolio that aligns with their long-term financial well-being while acknowledging their preferences. Option C. Advise the client that their preference for concentrated investing is too risky and proceed with a highly diversified portfolio without further discussion, as this is the only prudent option. Option D. Immediately implement the client's preferred strategy of investing in only 2 high-growth stocks to satisfy their stated desire for simplicity and maximum immediate returns. The correct answer is B. Explain the principles of diversification and its role in mitigating risk, guiding the client towards a more balanced portfolio that aligns with their long-term financial well-being, while acknowledging their preferences. Explanation. This scenario is professionally challenging because it requires an investment advisor to balance the client's stated desire for simplicity and immediate returns with the fiduciary duty to act in the client's best interest, which includes prudent portfolio construction. The advisor must navigate the inherent tension between a client's potentially short-sighted preferences and the long-term benefits of a well-diversified portfolio, as mandated by regulatory principles. The correct approach is to explain to the client the fundamental principles of diversification as a risk management strategy, emphasizing how it aligns with the fiduciary duty to protect the client's assets from undue concentration risk. This involves educating the client on how spreading investments across different asset classes, industries, and geographies can reduce volatility and improve risk-adjusted returns over the long term, even if it means foregoing the potential for extremely high, concentrated gains. This aligns with the Investment Advisors Act of 1940, which imposes a fiduciary duty on investment advisors to act in the best interests of their clients, requiring them to provide advice that is suitable and prudent. An incorrect approach would be to immediately acquiesce to the client's request for a concentrated portfolio of only 2 high-growth stocks. This fails to uphold the fiduciary duty by exposing the client to excessive unsystematic risk. The regulatory failure here is a breach of the duty of care and loyalty, as the advisor is not acting in the client's best interest by ignoring established principles of prudent investing. Another incorrect approach would be to dismiss the client's concerns about diversification as uninformed and proceed with a highly diversified portfolio without adequate explanation or client buy-in. While diversification is generally beneficial, an advisor must also consider the client's risk tolerance, investment objectives, and financial situation. Forcing a diversification strategy without client understanding or agreement can lead to dissatisfaction and potential complaints, and it overlooks the importance of client communication and suitability. This approach fails to adequately address the client's stated preferences and could be seen as a lack of client-centric advice, even if the underlying strategy is sound. The professional decision-making process for similar situations involves a thorough understanding of the client's objectives, risk tolerance, and financial situation. It requires clear and transparent communication about investment strategies, including the rationale behind diversification and its benefits. Advisors must be prepared to educate clients on complex financial concepts and to tailor advice to individual circumstances, always prioritizing the client's best interests as mandated by fiduciary duty. When a client's request conflicts with prudent investment principles, the advisor's role is to explain the risks and benefits, guide the client towards a suitable strategy, and document the rationale for all recommendations. Question 13. Compliance review shows that an investment advisor received a specific instruction from a client to execute a trade through a particular broker-dealer, even though the advisor's internal analysis indicates that another broker-dealer could likely achieve a better net price for the same security. The client stated that they have a personal relationship with the owner of the first broker-dealer. Which of the following represents the most appropriate course of action for the investment advisor? Option A. Inform the client that the instruction cannot be followed because it violates the duty to seek best execution and proceed with executing the trade through the broker-dealer offering the best net price. Option B. Execute the trade through the broker-dealer that offers the best net price, regardless of the client's instruction, as the advisor's fiduciary duty supersedes client direction. Option C. Discuss with the client the advisor's duty to seek best execution. Explain the potential implications of their instruction on achieving the most favorable terms, and seek to reach a mutually agreeable execution strategy. Option D. Execute the trade through the client's specified broker-dealer, but document the client's instruction and the advisor's understanding that this may not be the best execution. The correct answer is D. Execute the trade through the client's specified broker-dealer, but document the client's instruction and the advisor's understanding that this may not be the best execution. Explanation. This scenario presents a professional challenge because it requires an investment advisor to balance the client's stated preference with the advisor's fiduciary duty to seek best execution. The client's instruction, while seemingly straightforward, could lead to a suboptimal outcome for the client if not handled with careful consideration of the advisor's obligations. The advisor must navigate the tension between client direction and the regulatory mandate to act in the client's best interest, particularly concerning transaction costs and market impact. The correct approach involves acknowledging the client's preference, but also informing the client about the potential implications of their instruction on best execution. This means explaining that while the client has a right to direct trades, the advisor still has a duty to ensure that the execution of those trades is done in a manner that seeks the most favorable terms reasonably available under the circumstances. This includes considering factors like price, speed of execution, and the likelihood of achieving the desired outcome, and then discussing these with the client. If the client's instruction demonstrably compromises best execution, the advisor should explain this and propose alternative execution strategies that align with the client's goals while fulfilling the duty to seek best execution. This aligns with the principles of the Investment Advisors Act of 1940, which imposes a fiduciary duty on investment advisors to act in the best interests of their clients. An incorrect approach would be to blindly follow the client's instruction without any discussion or consideration of best execution. This fails to uphold the fiduciary duty, as it prioritizes the client's potentially uninformed directive over the advisor's obligation to secure the most advantageous execution. Another incorrect approach would be to refuse to follow the client's instruction outright without a thorough explanation of why it conflicts with best execution, and without offering alternative solutions. This could be seen as disregarding client autonomy and failing to engage in a collaborative process to achieve the client's objectives. Finally, an incorrect approach would be to execute the trade in a way that clearly does not seek best execution, even if the client provided a general instruction, without any attempt to mitigate the negative impact or explain the trade-offs. The professional decision-making process for similar situations should involve a clear understanding of the fiduciary duty to seek best execution. When a client provides specific instructions that may impact execution quality, the advisor should 1. Understand the client's objective behind the instruction. 2. Assess the potential impact of the instruction on best execution, considering market conditions and available trading venues. 3. Communicate transparently with the client, explaining the advisor's duty and the potential consequences of their instruction. 4. Propose and discuss alternative execution strategies that balance client preference with the duty to seek best execution. 5. Document the client's decision and the advisor's rationale. Question 14. Governance review demonstrates that an investment advisor is exploring options for storing client account statements, trade confirmations, and correspondence electronically. The firm is considering several approaches to manage these records, aiming for efficiency and cost savings while ensuring regulatory compliance. Which of the following approaches best satisfies the requirements for electronic record storage under the Investment Advisors Act of 1940? Option A. Utilizing a cloud storage service that offers basic file synchronization but lacks specific security protocols or documented backup verification procedures. Option B. Maintaining records on a single, unencrypted local server that is accessible to all employees without specific access controls or regular data integrity checks. Option C. Implementing a secure, cloud-based storage solution with robust encryption, regular automated backups to geographically diverse locations, and a comprehensive audit trail for all record access and modifications. Option D. Storing all electronic records on the firm's internal network servers with no off-site backup or disaster recovery plan in place. The correct answer is C. Implementing a secure, cloud-based storage solution with robust encryption, regular automated backups to geographically diverse locations, and a comprehensive audit trail for all record access and modifications. Explanation. This scenario presents a common challenge for investment advisors, ensuring compliance with record-keeping regulations in an increasingly digital environment. The professional challenge lies in balancing the efficiency and cost-effectiveness of electronic storage with the stringent requirements for accessibility, security, and integrity mandated by regulatory bodies. Investment advisors must implement robust systems and procedures to safeguard client information and maintain accurate, retrievable records for examination purposes. The correct approach involves implementing a system that ensures electronic records are readily accessible, unalterable, and backed up. This aligns with SEC Rule 204-2 under the Investment Advisors Act of 1940, which requires investment advisors to maintain certain records and make them available for inspection. Specifically, the rule mandates that records be preserved in a format that prevents alteration or erasure, and that they be readily accessible. A system that includes secure, redundant backups and a clear audit trail for any modifications directly addresses these requirements. An approach that relies solely on cloud storage without specific security protocols or regular backup verification fails to meet the accessibility and integrity requirements. While cloud storage can be efficient, it must be implemented with a clear understanding of data security and redundancy to prevent loss or unauthorized access, which is a violation of the advisor's duty to maintain accurate and accessible records. Another incorrect approach, storing records only on local network drives without a disaster recovery plan, creates a significant risk of data loss. A hardware failure, cyber attack, or natural disaster could render these records irretrievable, violating the requirement for records to be preserved and accessible. Finally, an approach that stores records on a single, unencrypted server without any form of backup or access control is highly problematic. This not only exposes sensitive client data to unauthorized access, but also creates a single point of failure, making the records vulnerable to permanent loss and failing to meet the integrity and accessibility mandates. Professionals should approach electronic record keeping by first thoroughly understanding the specific requirements of SEC Rule 204-2. This involves designing or selecting a record-keeping system that prioritizes data integrity, security, and accessibility. Regular testing of backup and recovery procedures, along with ongoing monitoring of system security, is crucial. When evaluating vendors or implementing new technologies, advisors must ensure they meet regulatory standards and align with their fiduciary duties to protect client information. Question 15. The monitoring system demonstrates that a certified public accountant, CPA, who primarily provides tax preparation services, has recently begun offering clients a service where they review client investment portfolios and provide recommendations on asset allocation, charging a separate, fixed annual fee for this portfolio review service. Which of the following actions is most consistent with federal exemptions for investment advisors? Option A. The CPA continues to offer the portfolio review service, arguing that the fixed annual fee is not performance-based and therefore does not disqualify them from an exemption. Option B. The CPA ceases offering the portfolio review service as it is not covered by the incidental advice exemption for accountants. Option C. The CPA registers as an investment advisor with the Securities and Exchange Commission, SEC, before continuing to offer the portfolio review service. Option D. The CPA continues to offer the portfolio review service without registering as an investment advisor, asserting that their primary profession is accounting and the advice is incidental. The correct answer is D. The CPA continues to offer the portfolio review service without registering as an investment advisor, asserting that their primary profession is accounting and the advice is incidental. Explanation. This scenario presents a professional challenge because it requires distinguishing between providing incidental advice as part of a recognized profession and engaging in the business of providing investment advice, which triggers registration requirements under the Investment Advisors Act of 1940. The core difficulty lies in the subjective nature of incidental and the potential for even well-intentioned professionals to inadvertently cross the line into regulated activity. Careful judgment is required to ensure compliance without unduly burdening legitimate professional practices. The correct approach involves recognizing that an individual who is a lawyer, accountant, teacher, or engineer, and whose investment advice is solely incidental to their primary professional services, is exempt from registration as an investment advisor. This exemption is based on the premise that their primary expertise and client relationship are not centered on investment management. The advice provided is a secondary benefit of their core professional engagement. This aligns with the intent of federal securities laws to regulate those who hold themselves out as investment advisors and receive compensation for such services, rather than professionals whose primary role is elsewhere. An incorrect approach would be to assume that any investment-related discussion or recommendation, regardless of its context or the professional's primary role, automatically falls under the exemption. For instance, a lawyer who actively solicits clients by offering investment strategies alongside legal counsel, or an accountant who develops a fee structure based on the performance of investment portfolios they recommend, would likely be deemed to be in the business of providing investment advice. This would necessitate registration as an investment advisor, and failure to do so would be a violation of federal securities laws. Similarly, a publisher of a bona fide financial publication that is impersonal and general in nature is exempt. But if the publisher begins to offer personalized investment advice or manage client accounts, they would lose this exemption and be required to register. The professional reasoning process should involve a clear understanding of one's primary professional role and the nature of any investment-related services offered. If the investment advice is a secondary, incidental component of a primary professional service, and no special compensation is received for the investment advice itself, the exemption may apply. However, if the professional actively markets investment advisory services, receives direct compensation for investment advice, or provides personalized investment management, they must assess whether registration as an investment advisor is required. Consulting with legal counsel specializing in securities law is advisable when there is any doubt about the applicability of an exemption. Question 16. Strategic planning requires an investment advisor to consider a client's stated desire for aggressive, high-growth investments. However, the advisor's due diligence reveals that the client's financial capacity for risk is significantly lower than their stated appetite due to substantial existing debt and a short-term need for liquidity. Which of the following represents the most appropriate course of action for the investment advisor? Option A. Recommend a diversified portfolio that balances the client's growth objectives with their actual risk tolerance and financial situation, educating the client on the rationale behind this approach. Option B. Invest the client's funds in a mix of aggressive growth funds and speculative assets, hoping that some will perform exceptionally well to offset potential losses. Option C. Proceed with the client's request for highly speculative investments, as the client is ultimately responsible for their investment decisions. Option D. Advise the client that their investment goals are unrealistic given their financial situation, and suggest they abandon their growth objectives. The correct answer is A. Recommend a diversified portfolio that balances the client's growth objectives with their actual risk tolerance and financial situation, educating the client on the rationale behind this approach. Explanation. This scenario presents a common ethical dilemma for investment advisors registered in the U.S., governed by the Investment Advisors Act of 1940 and state securities laws. Challenge lies in balancing a client's stated desire for aggressive growth with the advisor's fiduciary duty to recommend suitable investments, even if those recommendations are more conservative. The advisor must act in the client's best interest, which may conflict with the client's immediate, potentially ill-informed preferences. The correct approach involves a thorough understanding of the client's financial situation, investment objectives, risk tolerance, and time horizon. It requires the advisor to educate the client about the risks and potential rewards of various strategies, and then recommend a plan that aligns with their overall financial goals and capacity for risk, even if it means tempering the client's initial aggressive inclinations. This aligns with the fiduciary standard, which mandates that advisors place their clients' interests above their own and act with the utmost good faith. Specifically, Rule 206(4)(1) under the Advisors Act, the Marketing Rule, and the general anti-fraud provisions of the Act prohibit advisors from making recommendations that are not suitable for their clients. An incorrect approach would be to blindly follow the client's directive for highly speculative investments without a proper suitability assessment. This would violate the advisor's fiduciary duty and potentially expose the client to undue risk, leading to a breach of the Investment Advisors Act of 1940. Another incorrect approach would be to dismiss the client's stated objectives entirely without attempting to understand the underlying reasons for their desire for aggressive growth. This could alienate the client and fail to address their genuine financial aspirations, even if those aspirations need to be managed within a realistic framework. Finally, recommending investments solely based on recent market trends or hot tips without considering the client's individual circumstances is a clear violation of the suitability requirements and the advisor's duty of care. Professionals should approach such situations by first conducting a comprehensive discovery process to understand the client's complete financial picture and motivations. This should be followed by a clear explanation of investment principles, risk management, and the trade-offs involved in different strategies. The advisor should then present a tailored recommendation that addresses the client's goals while adhering to regulatory and ethical standards, fostering an open dialogue to ensure the client understands and agrees with the proposed plan. Question 17. Investigation of an investment advisor's procedures for terminating an advisory contract with a client reveals that, upon receiving the client's written request to terminate, the advisor immediately ceases all investment advice and management services. The advisor then promptly sends the client a letter confirming the termination date, outlining the process for liquidating any remaining positions, and detailing any pro rata fees owed up to the termination date. The advisor also provides instructions on how the client can transfer their assets to another custodian or receive them in cash. Which of the following best describes the advisor's actions in this termination scenario? Option A. The advisor has violated regulations by not providing a detailed report of all past investment recommendations made during the advisory relationship. Option B. The advisor has acted in accordance with regulatory requirements and ethical best practices for terminating an advisory contract. Option C. The advisor has acted improperly by not immediately transferring the client's assets to a new advisor designated by the client. Option D. The advisor has failed to act in the client's best interest by not offering to manage the assets for a transition period. The correct answer is B. The advisor has acted in accordance with regulatory requirements and ethical best practices for terminating an advisory contract. Explanation. This scenario presents a professional challenge because an investment advisor must navigate the termination of an advisory contract while adhering strictly to the Investment Advisors Act of 1940 and state securities laws, which are the governing regulations for the Series 65 exam. The core of the challenge lies in ensuring that the termination process is conducted ethically, transparently, and in compliance with all disclosure and record-keeping requirements. Failure to do so can result in regulatory sanctions, reputational damage, and harm to the client. The correct approach involves promptly notifying the client of the termination, clearly stating the effective date, and providing all necessary information regarding the disposition of the client's assets and any outstanding fees. This approach is correct because it aligns with the fiduciary duty owed to the client and the regulatory obligation to act in the client's best interest. Specifically, Rule 204-2 under the Investment Advisors Act of 1940 mandates the preservation of records related to advisory contracts, including their termination. Furthermore, principles of fair dealing and full disclosure, inherent in the advisor's fiduciary role, require that clients be fully informed about the cessation of services and the handling of their accounts. An incorrect approach would be to delay notification to the client while continuing to accrue fees. This is a regulatory and ethical failure because it violates the duty of full and fair disclosure. The client is no longer receiving advisory services and continuing to charge fees without explicit consent or a clear contractual basis for such charges is a form of misrepresentation and potentially fraudulent activity. It also breaches the fiduciary duty by prioritizing the advisor's financial gain over the client's interests. Another incorrect approach would be to unilaterally transfer the client's assets to another firm without the client's explicit instruction and consent. This is a significant regulatory and ethical failure. It disregards the client's autonomy and control over their assets, potentially exposing them to unwanted investment strategies or higher fees. It also violates record-keeping requirements and could be construed as unauthorized trading or conversion of client assets. A third incorrect approach would be to fail to provide a final accounting of fees and expenses. This is a regulatory failure, as it hinders the client's ability to understand the financial implications of the termination and can lead to disputes. It also undermines the transparency expected of an investment advisor and can be seen as an attempt to obscure financial details, which is contrary to the principles of fair dealing. The professional decision-making process for similar situations should begin with a thorough review of the advisory contract to understand the specific terms and conditions governing termination. This should be followed by immediate and clear communication with the client, detailing the termination date and the steps being taken to wind down the advisory relationship. All actions must be documented meticulously to comply with record-keeping regulations. The advisor must always prioritize the client's best interests, ensuring a smooth and transparent transition that respects the client's rights and financial well-being. Question 18. Market research demonstrates that prospective clients are increasingly seeking detailed information about an investment advisor's business practices and potential conflicts of interest before engaging their services. An investment advisor is preparing to onboard a new client, and is considering how to best fulfill their disclosure obligations under the Investment Advisors Act of 1940. The advisor has identified several potential conflicts, including receiving performance-based fees for certain accounts and having affiliated entities that offer other financial services. Which of the following approaches best satisfies the disclosure requirements for this investment advisor? Option A. Providing the prospective client with a written document that includes the firm's Form ADV Part 2A and the relevant Form ADV Part 2B supplements for the individuals who will be advising the client, ensuring these documents clearly detail all services, fees, conflicts of interest, and disciplinary history. Option B. Delivering a lengthy legal document filled with complex financial and regulatory jargon that covers all potential disclosures, but is not organized for easy client comprehension. Option C. Providing a generic brochure that broadly outlines the firm's services, but omits specific details about performance-based fees and affiliated entities, stating that such information is available upon request. Option D. Verbally discussing potential conflicts of interest, such as performance-based fees and affiliated entities, with the prospective client during the initial meeting, assuring them that these are standard industry practices. The correct answer is A. Providing the prospective client with a written document that includes the firm's Form ADV Part 2A and the relevant Form ADV Part 2B supplements for the individuals who will be advising the client, ensuring these documents clearly detail all services, fees, conflicts of interest, and disciplinary history. Explanation. This scenario is professionally challenging because it requires an investment advisor to balance the need for transparency and disclosure with the potential for overwhelming clients with excessive information. The advisor must understand the specific disclosure requirements under the Investment Advisors Act of 1940, as interpreted by the SEC and relevant case law, to ensure compliance and ethical conduct. The core of the challenge lies in determining what constitutes material information that must be disclosed, and how to present it in a clear, concise, and understandable manner. The correct approach involves providing a comprehensive and easily accessible disclosure document that clearly outlines all potential conflicts of interest, compensation arrangements, and any other information that a reasonable client would consider important in making an investment decision. This aligns with the fiduciary duty inherent in the investment advisor-client relationship, which mandates acting in the client's best interest and disclosing all material facts. Specifically, this would involve delivering the firm's Form ADV Part 2A, the brochure, and Part 2B, the brochure supplement for individual advisors, to prospective and existing clients. These documents are designed to provide clients with the necessary information to evaluate the advisor's services, qualifications, and potential conflicts. An incorrect approach would be to only verbally disclose potential conflicts of interest without providing a written document. This fails to meet the regulatory requirement for written disclosure and leaves the client with no tangible record of the information, making it difficult to recall or reference later. Another incorrect approach would be to provide a generic disclosure document that does not specifically address the unique services offered or the particular conflicts that may arise from those services. This lacks the specificity required to be truly informative to the client. Finally, an approach that buries important disclosure information within lengthy, jargon-filled legal text without clear headings or summaries would also be considered inadequate, as it hinders the client's ability to understand the material facts. Professionals should approach disclosure by first understanding the specific requirements of the Investment Advisors Act of 1940 and the SEC's interpretations. This involves recognizing that disclosure is not merely a procedural step, but a fundamental aspect of the fiduciary duty. When faced with a disclosure decision, an advisor should ask, would a reasonable investor consider this information important in deciding whether to hire me or continue to employ me? If the answer is yes, then disclosure is likely required. The information should then be presented in a clear, concise, and understandable format, allowing the client to make an informed decision. Question 19. Stakeholder feedback indicates a concern that investment advisors might be influenced by preferential treatment offered by third-party service providers. An investment advisor has been approached by a software vendor who offers a significant discount on their platform if the advisor recommends their services to clients. The vendor's platform is a viable option for clients, but but it is not definitively superior to other available solutions. How should the investment advisor proceed to ethically and legally manage this situation? Option A. Accept the vendor's offer for the discount, disclose the discount to clients, and then recommend the vendor's platform as it is a viable option. Option B. Evaluate the vendor's platform objectively for its suitability for clients, disclose the potential conflict of interest arising from the vendor's offer to clients, and only recommend the platform if it is demonstrably in the client's best interests based on independent analysis. Option C. Accept the vendor's offer for the discount and recommend the vendor's platform to clients without disclosing the discount, as the platform is a viable option. Option D. Decline the vendor's offer and recommend a different, well-researched solution without considering the vendor's platform further to avoid any appearance of impropriety. The correct answer is B. Evaluate the vendor's platform objectively for its suitability for clients, disclose the potential conflict of interest arising from the vendor's offer to clients, and only recommend the platform if it is demonstrably in the client's best interests based on independent analysis. Explanation. This scenario is professionally challenging because it requires an investment advisor to balance the interests of their clients with potential business relationships, while strictly adhering to the fiduciary duty and the Investment Advisors Act of 1940. The core of the challenge lies in ensuring that any recommendation made is solely in the client's best interest, free from undue influence or personal gain. The advisor must navigate potential conflicts of interest with integrity and transparency. The correct approach involves prioritizing the client's interests above all else, even if it means foregoing a potentially lucrative business opportunity. This aligns with the fiduciary standard mandated by the Investment Advisors Act of 1940, which requires investment advisors to act with the utmost good faith and in the best interests of their clients. Specifically, Rule 206(4)(7) under the Act mandates that advisors establish and maintain policies and procedures reasonably designed to prevent violations of the Act and the rules thereunder, including those related to conflicts of interest and best execution, disclosing the potential conflict, and then proceeding with a recommendation only if it is demonstrably in the client's best interest, supported by objective analysis, upholds this fiduciary duty. An incorrect approach that involves accepting the vendor's offer and then making a recommendation based on that offer, even with disclosure, fails to uphold the fiduciary standard. Disclosure alone does not cure a conflict of interest if the recommendation is not genuinely the best option for the client. This could be seen as a violation of the advisor's duty of loyalty and care. Another incorrect approach, which is to decline the vendor's offer and then make a recommendation without any further consideration of the vendor's services, might seem safe but could also be problematic. If the vendor's services genuinely offer superior value or a better solution for the client, refusing to consider them solely due to the potential conflict, without objective evaluation, could be seen as failing to act in the client's best interest. The advisor has a duty to seek out the best solutions for their clients. Finally, an approach that involves accepting the vendor's offer and making the recommendation without any disclosure to the client is a clear violation of ethical and regulatory requirements. This constitutes a breach of trust and a failure to manage conflicts of interest transparently, potentially leading to undisclosed self-dealing or preferential treatment. The professional decision-making process for similar situations should involve a rigorous assessment of any potential conflict of interest. This includes identifying the conflict, evaluating its impact on client recommendations, determining if the conflict can be eliminated or mitigated, and if not, ensuring full and fair disclosure to the client. The ultimate decision must always be driven by what is demonstrably in the client's best interest, supported by objective analysis and documentation. Question 20. When evaluating whether a former registered representative who is moving to a new role within the same firm needs to register as an investment advisor representative (IR), which of the following approaches best ensures compliance with federal and state securities regulations? Option A. Confirming that the individual's compensation is solely derived from commissions on the sale of securities, as this is a common exclusion for broker-dealer representatives. Option B. Relying on the firm's internal compliance department to make the determination without the individual independently reviewing the regulatory requirements for their specific role. Option C. Assuming that because the individual was previously registered as a representative, their new role does not require IAR registration, regardless of the specific duties performed. Option D. Conducting a detailed analysis of the individual's new job description, compensation structure, and the nature of the services they will provide to clients to determine if they meet the definition of an investment advisor representative and are not eligible for any exclusions. Correct answer is A. Confirming that the individual's compensation is solely derived from commissions on the sale of securities, as this is a common exclusion for broker-dealer representatives. Explanation. This scenario presents a common challenge for individuals transitioning between roles in the financial services industry. The core difficulty lies in accurately determining when an individual's activities necessitate registration as an investment advisor representative IR under the Investment Advisors Act of 1940 and applicable state securities laws, as interpreted by the SEC and state securities administrators. Misinterpreting these requirements can lead to significant regulatory violations, including operating as an unregistered IAR, which carries severe penalties. Careful judgment is required to distinguish between activities that are purely administrative or incidental to a registered broker-dealer or investment company, and those that constitute providing investment advice or managing investment portfolios for compensation. The correct approach involves a thorough understanding of the statutory definition of an investment advisor and the exclusions provided within the Investment Advisors Act of 1940. Specifically, it requires analyzing whether the individual's compensation is solely for services that are not investment advice, or if their activities fall under specific exemptions. For an individual transitioning from a registered representative role to a position where they will be offering investment advice for compensation, the critical step is to assess if their new duties align with the definition of an IAR. This necessitates a detailed review of their proposed responsibilities, compensation structure, and the nature of the services they will provide to clients. If their activities involve providing advice about securities, issuing reports or analyses regarding securities, or managing securities portfolios for compensation, and they do not qualify for an exclusion, then registration as an IAR is mandatory. This proactive assessment ensures compliance with federal and state registration requirements, protecting both the individual and their firm from regulatory scrutiny and potential penalties. An incorrect approach would be to assume that because the individual was previously a registered representative, their new role automatically exempts them from IAR registration. This fails to recognize that the nature of the services provided, not just the prior registration status, dictates the current registration requirements. Another incorrect approach is to rely solely on the firm's internal classification without independently verifying the regulatory definition of an IAR and the specific duties being performed. This can lead to a firm-wide compliance failure if the firm's internal policies are not aligned with regulatory mandates. Furthermore, an incorrect approach would be to proceed with offering investment advice for compensation without confirming registration status, hoping to address it later. This demonstrates a disregard for the proactive nature of regulatory compliance and exposes the individual and firm to significant risk. Professional decision-making in such situations requires a systematic process. First, clearly define the individual's proposed duties and compensation. Second, consult the relevant sections of the Investment Advisors Act of 1940 and any applicable state securities laws, paying close attention to the definitions of investment advisor and investment advisor representative, as well as any relevant exclusions or exemptions. Third, if there is any ambiguity, seek guidance from legal counsel or compliance professionals specializing in investment advisor regulation. Finally, ensure that all necessary registrations are filed and approved *, before * engaging in any activities that require them.